All right, everybody, welcome to our presentation tonight. We're talking about the tax advantages for the real estate investor, and we're going to do a webinar tonight. We're going to get the presentation underway here right on time. And first of all, we just wanted to thank you for attending tonight. And we're going to go over the tax benefits for the passive investor, and we are so fortunate to have two of the best in the business tonight to kind of assist me. I'm Ryan Gibson with Spartan Investment Group to talk about how both the active and passive investors specifically benefit from investing in real estate, and in this case, a partnership that we're going to go through a case study that Spartan Investment Group put together for passive investors to invest in. So my name is Ryan Gibson, and I am the CEO or CIO of Spartan Investment Group. Spartan is basically a real estate development and syndication company that specializes in providing investors with commercial real estate investment opportunities that are completely 100% passive. And I'm excited to have with me tonight Yona Weiss from Madison Specs. And Yona, want to say hello and give a little introduction on your background and a little bit about what Madison Specs does?
Sure. Thanks, Ryan, for having us and putting this together. It's bound to be quite a special webinar. A little bit about myself. I really have a background in teaching, which allows me to, enjoy these webinars a little more than another might. And a few years ago, I got involved in real estate in multiple different levels, just trying to learn as much as I can. And I won't get too much detail into that for the sake of the audience and getting into the content, but specifically in my latest role with Madison Specs. Madison is actually part of a greater umbrella organization, Madison Commercial Real Estate Services. We have a number of specialized services for commercial real estate investors, title insurance, 1031 exchanges, due diligence, lease abstracting for larger projects mostly, and cost segregation is specifically what Specs deals with. And we are a national firm dealing in all 50 states, having completed over 13,000 cost segregation studies over the past 12 years, and really growing in the past this year alone. We're close to 2,000 studies, so that's really this is our biggest year yet, 2018, and happy to have colleagues like Ryan and Mark to share some great knowledge with you tonight.
Thanks so much, Yona, and yeah, I really appreciate you coming on here. Just a little background: Yona, Madison Specs is actually doing our cost segregation study as we speak at Aspen Park Self Storage in Colorado, which is our most recent acquisition. So thank you so much, Yona. So Mark from Hunt Jackson. Mark does all of our taxes and accounting, is very familiar with real estate. Mark, why don't you introduce yourself?
Hi, yeah, sure. As Ryan mentioned, I've been a CPA for about 12 years, very involved in real estate, and I guess you could say all things real estate related to accounting. We do well over 300 tax returns every year that have some aspect of real estate investing involved, whether it's syndication, development, partnership, or just a retired couple that owns a few rentals. It's kind of funny. I actually navigated the beginning of my career trying to stay away from real estate because I am a real estate investor, and I thought maybe it was wise to keep my assets in a separate industry. But I just love it. I mean, what can I say? It kept following me around my whole career. So, really happy to be a part of this. Thanks for having me today, and hopefully we could help everybody out with some information here.
Great. Thanks, Mark. Okay, so great. So tonight we're going to run through specifically how cost segregation works for both active and passive investors. And we're going to have a fair amount of time to answer questions at the end of the presentation. So take any notes that you'd like. If you'd like to ask any questions, hold it for the Q&A session. We have a little chat box window in the GoToWebinar controls at the bottom. Also, some housekeeping. We do have a handout. So if you want a copy of this presentation, If you want to get in touch with myself or Yona or Mark, all of our contact information is included at the bottom of the presentation, which is in the last slide. So we hope that tonight you can go ahead and take away how all investors in a partnership, whether you're active or passive, benefit when investing in an asset that allows for bonus depreciation or cost segregation. And specifically, we're going to look at a self-storage facility that Spartan Investment Group acquired along with its investor network this past August. So with that, we'll go ahead and jump into the presentation. So first of all, this is the slide for our attorneys. We're going to introduce some new tax code tonight that was introduced in 2018. And obviously, a lot of it's being kind of interpreted, challenged. So information tonight that is presented was subject to change. We're not offering any tax and legal professional advice to you. You know, seek your outside counsel and your financial and legal team. We're not offering advice. This is just a general overview of information. Obviously, as I said earlier, information is contained is subject to change. Perform your own due diligence. And I also want to stress that, again, new tax law is currently under review. So with all of those disclaimers out of the way, we're going to go ahead and just kind of talk about the tax benefits of investing in a syndication that can reduce overall partnership tax liability, and how both investors, the active investor that's putting together the investment, and in this case, Spartan Investment Group, and its passive investors or its limited members, are sharing in that tax advantage or these tax shields that we get from cost segregation, bonus depreciation, and all these other nice benefits. And at the end of the day, it increases the investor cash flow. So with the income tax benefit that it creates, you're basically being shielded from from regular taxes that you would pay. You're being shielded throughout the life of the investment. And I really like this because, a lot of, our company was started in flipping houses and kind of building and selling within the same year. And you didn't really have much of a tax benefit. It just kind of was all taxed at earned income. And what I like about our company's pivot to commercial kind of long-term asset investing is you get the building depreciation and some other benefits from kind of holding the asset for a little bit longer of a time. And we're also going to talk about how at the end of these benefits, you can also kind of continue to defer these gains to a 1031. So with that, I'm going to turn it over to Yona, who is an expert at depreciation, cost segregation, and bonus depreciation. So Yona, go ahead and take us away on that.
Okay, just to give a little bit of basic fundamentals about depreciation. The first thing we need to know is depreciation is a tax deduction. And this is something that every property owner, if it's an investment property, whether a business property or an investment property, as long as it's not your personal residence, gets to take and is actually required. If you don't do it, the IRS will still consider it as if you did take depreciation, which we'll get to later upon sale. Now, how does depreciation work? It's a concept that everyone understands, that when you buy something, you own something, the longer you own it, it goes down in value. Like, for example, I'll have to give the example, if you drive a car off the lot, you know that the Blue Book value goes down the next day, even though intrinsically the value doesn't go down. Nevertheless, the IRS gives you a tax deduction in order to benefit from the ownership of this property and the fact that it's going down in value as you're holding it. And the first fundamental depreciation is they allocate this deduction over the life of 39 years for commercial property. And for residential, that's multifamily or single family, 27 and a half years. So how that works is you take the purchase price. Now, again, depreciation starts from day one when you buy the asset. It has nothing to do with when the building was built if you're acquiring it. Now, of course, if you're building it, if you're constructing from new, which I know Ryan and Spartan have done, so the depreciation there starts when you place it in service. That means when it actually starts being up and running. However, when you're buying the asset, it has nothing to do with when it was built. It has to do with when you acquire it, as long as there are tenants in there. So now, how do? You take the purchase price and you deduct a certain percentage for land, which we're going to get to shortly as well. And that leftover amount results in your basis. Divide that up over 39 years, and that's the amount that you can deduct every year on your tax return. So simple math. Let's say you have a property that you bought for $1 million. You deduct, let's say, 15% for land. It's going to leave you with 850. Just simple math. Divide that by 39 years. Okay, you're left with a deduction of approximately, let's say, around $20,000, $20 or so thousand a year. Okay, that's not a lot, but if you can get a lot more of that in the early years, you'd want to do that, because the whole principle, or one of the main principles of cost segregation, is the time value of money and the value of the cash flow that you can actually use. Reduce your taxes rather, and enable yourself to use the money that you earned to reinvest. So cost segregation allows you to, according to the IRS's rules, to break down the property to further and faster depreciation lives from the 39 and 27, which breaks down into usually the biggest categories are 5-year property and 15-year property. 5 years includes basically anything that's inside of the building. So we'll talk about it's called personal property or tangible property, but that includes really anything that is in the building that isn't part of the main structure of the building. So if you can think about things like furniture, appliances, cabinetry, even carpeting or floor tiles in many cases, lighting fixtures, all kinds of other fixtures. There are really over a dozen categories of things that will fit into those different 5-year categories. And the 15-year asset, which is called land improvements, includes anything outside of the building that is not the actual land. So landscaping or pavement or outside lighting or fencing, things like that signage have to do with 15-year property. And all of these two categories, it means you can take the life of those things, the value of those assets, and depreciate them over a faster period. Now, how do you do that? You actually need an engineer. The IRS says you need an engineer, someone who is versed not just in building and in construction and engineering, but actually in the tax code, in order to understand how the IRS deals with these different assets at different property values, and say, hey, the cabinetry in this property is actually worth X amount of money. I can depreciate that value over 5 years and therefore get a tax deduction, much greater tax deduction in the early years of ownership. And so that's what we mean by accelerating tax depreciation. Now, there's actually more to accelerating depreciation, because not to get too technical, but Mark might want to get into this later, but there's different ways of calculating the depreciation, something called double declining balance, which actually allows you to take a greater amount in the first year or second year of ownership than you would over the full 5 years. And we'll get to another important point with the new tax reform called bonus depreciation, which allows you to take the deductions of all of these 5 and 15-year assets over in the first year of ownership. Okay, so these are the basic fundamentals of depreciation. Again, it's a deduction. It's not a refund. If you have income and then you have a much greater amount of depreciation, you don't get the return. You don't get a check in return from the IRS if you take more than you need. But however, this is a way to shelter the income that you have. And this is really the way that many real estate investors continue to build their wealth and not be taxed on it. And in fact, with the recent article in New York Times about Jared Kushner, who has over $300 million of net worth and is not paying any income tax, while he's doing that legally through cost segregation. In fact, his family is a client of Madison Specs, so I know that for a fact. With that being said, I think that's really the basics of cost segregation, the fundamentals and depreciation that will allow you to produce, like it says over here, significant non-cash deductions and increase your cash flow.
That's great. Thanks, Yona. Let's talk about this new bonus depreciation. What is this all about?
Okay, so as I mentioned shortly before, the bonus depreciation, this is a new law that was passed. It was a law that previously exists, but in a little bit of a different form. Bonus depreciation, and it's a great word, everyone loves a bonus, right? But it allows you to take more depreciation in the first year of ownership than instead of spreading it out over the 39 years or even in an accelerated form over 5 or 15 years. So how does this work and how did it exist before? First of all, how it exists before only had to do with new construction. So if you were building, you were constructing a property, developing a property, or doing major renovations on the property, previously you were allowed to take 50% of the amount that you spent that was able to be capitalized and depreciated in the first year of ownership. And that was only for new construction, was only for new renovations, and only at 50%. The new tax law came in and said not only new construction, but actually any property that was placed in service by you for the first time, not just was placed in service at all for the first time, meaning any new acquisition can not only get the 50%, but actually can opt for 100% bonus depreciation. That means taking anything that has a depreciable life of less than 20 years. So all these things we talked about before, the personal property inside the building, that 5-year asset, or the land improvements outside of the building, which is 15-year assets, all of those, when calculated the asset value, instead of spreading it over 5 and 15 years, you can actually lump it all together and take that entire amount in the first year, which really creates a huge amount of paper loss, a huge amount of deductions. So for someone who has a very high income, and usually those people with high incomes have high income tax rates, you don't want to be paying tax on the money that you're making. So this is a great way for real estate investors to shield that income in the first year of ownership. And especially if you're continuously buying properties from year to year, it basically allows you to take the deductions this year and then the next property the next year, do the same thing and continue building your wealth and not being taxed on it. So again, just a couple notes on that. It's only allowed to be taken in the first year of ownership. So if you missed that window, you decided to not do the bonus depreciation, in the second year you can't take that. You can still do accelerated depreciation. You can still do something, what we talked about, the cost segregation, as we mentioned before. You can still take that in previous years. You can retroactively get all of those benefits that you missed if you didn't know about it. Let's say you just found out about this great thing, cost segregation, but I bought a property 3-4 years ago, Yona. What do? I missed it. No, you can actually file a form that's called 3115 form. And actually our firm and a lot of accountants love this, that we actually fill that for the clients as an extra service at no extra charge, which is a bit of a complicated form. So that's why the accountants love it. One extra thing they don't have to deal with. They're doing so much. So that form allows you to get the accelerated depreciation missed in previous years. So that's what bonus depreciation is. Again, it's taking 100% or 50% of those 5 and 15-year properties in the first year.
There's a couple of quick things I'd just like to highlight as well. And Yona, that was fantastic. One thing I like to point out to people, and I like to keep things pretty high level and simple, I let Yona go into all the details, of course. 100% bonus depreciation, that's a new and very, very exciting thing. It is one of the few changes made in the tax reform in December that actually goes back in time. So if you made some improvements in the last quarter of 2017, even though that was before 2018, it's still high. I believe the date is September 27th. Off the top of my head, I believe that's what the date was. The other thing I wanted to mention is that the way that this pencils out for a lot of improvements is if you write it all off in the current year, and if you're able to pass that loss through your tax return, it's almost like you're getting 1/3 of the money that you spent back as a return on your tax liability at year end. So that's a huge incentive if you were thinking about doing some upgrades or repairs. And if I told you, well, yeah, you spend the money this year, but come April, you're going to get 1/3 of it back, that's a major incentive to do that now. Also, as Yona pointed out, generally it is assets with less than a 20-year life. That is all kinds of different components of a building. There's a really wide variety of work that you can do. So those are just a couple points I want to make sure that we touched on during this webinar today. So thanks, Yona.
No, thank you for pointing those two things out. It's really important and excellent additions to what I said.
That's great. Thanks, you guys. And so, you know, kind of the whole process of this, I wanted to stress, is shared between both the passive and the active investors in the partnership. So we're going to go through in a couple of slides. We're going to actually go through an acquisition, and the passive investors that are listening today can hear exactly how they benefit from the bonus depreciation, the cost segregation, and how we basically do all the work. Yona's team does the study. Mark does all the inputs on the tax return. The investor gets the K1, and they basically get all of the benefits from the taxes that kind of pass through to the partnership. So how does this whole cost segregation process work? So first of all, in step one, we purchase an asset. So in this case, we're going to talk about a self-storage facility in a partnership, and then we assign the land value that cannot be depreciated, as Yona discussed earlier. In this case, we're using a 15% land value for our example later on. And Yona, why don't you go ahead and explain the last three steps in the process?
Sure. And typically, you know, you did put your typically between 10 and 20%. That is pretty typical. However, it is important to note there are places in the country where the land values are significantly higher. So you want to take that into consideration, especially in places like California and in cities, in big cities, San Francisco. It's crazy, sometimes up to 60%. It's hard to believe, but, you know, and there are different precedents of how to reduce that or whatnot, but definitely contact your accounting professional to figure that out. So yeah, 15%, that's what we applied the land value to the self-storage facility. And what happens in a cost segregation study is, first things first, before even commissioning a firm like Madison Specs, we'll give you an upfront analysis, no charge, no obligation, which allows you to see our projections of what the cost will be and what the tax benefits will be if by performing a full cost segregation study. Now, those projections are really, you know, they're pretty accurate, although conservative. We try to always outperform and outbeat the actual estimate. However, it's based on, you know, thousands of properties that we've done similar to this asset. So our engineers are pretty online when they get those estimates. And actually tonight we're going to be looking at the estimate, because on this self-storage facility, we're still in the process. So haven't even gotten to the final numbers yet. So that being said, the next step is the engineer will actually go to the property, walk the property, take all the findings, pictures, and everything, which the IRS also requires for a quality cost segregation study to be done. And that's outlined. If anyone's curious about where this is all outlined, you can look up on the IRS website something called the Cost Segregation Audit Techniques Guide. And that in there basically delineates 13 principles, 13 different aspects of a quality cost segregation study. And one of them is that it should be done by an engineer. The second one is that they actually should go to the property, etc., which we'll be discussing. The next step is the engineer will take the findings and apply the values to all of the things in the property that he found and create a study. The study usually ends up being anywhere between 80 and 120 pages long, at least that's how we do it, which not only includes the findings, but includes all of the support documentation from the Internal Revenue Code and from subsequent court cases. And so everything that you're going to need to support the findings are in that study. The next thing is there are actually several, like I mentioned before, there are several different ways to calculate the depreciation once we perform the study. The study will break down those assets into 5 years, 7 years, or a couple of things that are 7-year category, 15 years, etc. And those findings, you will be able to produce a depreciation schedule. Instead of just the straight line of 39 years, you'll have it broken down. Then the partnership or the client will, the owner of the property will decide how they want to actually use that, and that will be together with their, obviously their tax professional to understand their overall tax situation to see what type of depreciation they would most like to use, whether to use the 100% bonus or 50% bonus or just the regular cost segregation. That's applied to their tax returns. And then the next step is, and that holds with you throughout the ownership of the property. Upon sale, we did mention before that there's something called dun 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 recapture tax. It's one of the most scary things, but you know what? It happens. What happens is that all the depreciation that you took over the course of ownership of the property, you have to pay a tax on. And that tax is called depreciation recapture tax. The IRS said, hey, it's great. Yeah, we gave you this free loan, basically, of taking all this depreciation deductions, and especially if you're doing cost segregation, a lot more. It's like an interest-free loan. But when you pay it back, you have to pay a tax on that amount. And that tax is capped at 25%. It can be less depending on the person's income tax rate, etc. But there are ways to shelter that as well, which is through 1031 exchange. However, with a partnership, it is a little more difficult and complicated to result in a 1031 exchange. For various reasons, there are ways to do it. However, we're not going to get too much detail into that process.
Yeah, there's just a couple of other things I'd like to add as well. Although depreciation recapture is certainly a bummer, it's not necessarily a deal breaker, I believe. If I'm assuming that most of the folks on this call are investing in syndicated real estate, I think it's safe to assume that they're pretty high income earners in their day jobs. So for that kind of a profile, your marginal tax rate is probably around 32 to 35%. So you get a deduction today on income that would otherwise be taxed around that 32 or 35%. And the trade-off is that way down the line when you sell the real estate, it's recaptured at 25%. So that spread, that difference between the rates is actually yours to keep. The other benefit that you still get is that $1 today is worth a lot more than $1 7 years from now or whenever it is that you sell the real estate. So even though that's sometimes a surprise for people, hopefully it's not if you're working with a good CPA, it's not necessarily a net loss because, again, you get to kick the can down the road. There's certainly a time value to money. And the other thing is likely for most people who I would imagine are on this call, the 25% rate is a deal compared to your marginal tax rate. So I just want to point that out.
Excellent points. Thank you.
Yeah, great points and great description of that. All right, so we'll go ahead and move right into Mark. Why don't you take us through very, very quickly sort of, what defines an active real estate investor versus a passive, and really what do those two distinctions mean for the losses or the deductions that they might get in a real estate syndication?
Yeah, great question. So there's a lot of different terms that are thrown around about this. There's active, there's passive. There's a term you may have heard called material participation. There's also a term you may have heard called real estate professional. I'm going to keep this extremely high level just for simplicity's sake. As you can see from the slide, when you're an active real estate investor, and I mean really active, not just getting into the technical definition of it, really substance over form, you are a real estate professional. As you can see here, you're working generally 750 hours a year on it. It is really tough to meet that threshold if you have a normal full-time job. It's actually pretty risky to try to claim that status if you have a full-time job. However, if you are a real estate broker, for example, and you're putting in your hours, you are certainly a real estate professional. And that umbrella, if you will, of that title, that also means you're a real estate professional for your passive activity, investing in one of Ryan's deals or another syndicator's deals. That's a really cool thing. Other folks, if you're a service professional that happens to work a little bit with real estate, you likely won't meet that threshold. This is really important because if you're an active real estate investor, not only can losses from real estate offset your active income, meaning your W-2 job or your real estate brokerage commissions or what have you, it'll also offset your passive income, meaning the passive income either from the syndication itself or from other rentals and other passive sources of income that you have. If you don't meet that threshold, which a lot of people who passively invest in syndications are usually not full-time real estate folks themselves, then you can only offset passive income with passive losses. You can't, if you're a doctor, you can't offset your medical income with paper losses from real estate. There's also a tiny little category that's in between these two, and that is if you are only very slightly involved. And again, I'm just trying to keep this in the plain English here. You can actually still write off some losses up to $25,000 in losses per year, so long as your income is below $100,000. But that phases out. So if you make above $150,000, you still can't go negative. But it's not a complete loss, because if you have a big paper loss but you're not allowed to get the benefit this year, what happens is it gets saved for you for a future year when you are able to take it. So if you have a higher level of passive income down the line, or more likely when you eventually sell the project and have a big gain, the loss that you wanted to take this year but you weren't allowed to, it is suspended, so it's saved, think of it like putting it in a piggy bank, so you get that benefit eventually down the line. So those are kind of some of the key parts here. Hopefully what was really clear from Yona's part is that you might have losses for taxes even though the thing's kicking out cash flow. And the whole idea behind this is accelerating depreciation so that you're getting losses on paper for tax purposes, which is not necessarily the same as how the real estate project is performing.
Cash in pocket and a loss on paper.
Yeah, that's the goal, right?
That's the goal. Yona, were you going to chime in on something?
No, I think that was excellent.
Okay.
Excellent explanation. No, absolutely.
Great. So we're gonna jump in right now to Aspen Park Self Storage. So this is a purchase that Spartan made for $1.5 million, and we are taking it through its paces and depreciating it with the help of Yona and Mark. So essentially, we decided to exclude the land at 15%. So that gave us a $1.288 dollar amount to work with to depreciate. So what we did was we did a cost segregation study, actually that's in process now, that allows us to accelerate $215,000 of depreciation. And I want to stress that this is an estimate. It's subject to final approval, but it's a pretty close number to what Madison Specs puts out in their estimate for how much short-term life we can pull out. And as we talked about earlier, that number can be bonus depreciated in year one, giving us a $215,000 potential bonus depreciation in year one. Now, there's a couple of tweaks to the tax law originally we heard that 20-year life and less was able to all bonus depreciate. Then we heard a different ruling or a different interpretation that it was just, I think, 5 and 7-year life. But for the purposes of this, their short-term life is $215,000.
I just want to chime in. Chime in for a second, Ryan. That just to point out that if you were not to do cost segregation, this asset, if you were to divide up 1.288 over 39 years, then your depreciation every year would just be about $33,000, and that's it. So that's right.
No, that's right. And I think that coupling that point, Yona, is really important to the purposes of doing this cost segregation study, because as Mark pointed out as well, the arbitrage between the recapture tax and the earned income that someone would pay, as an investor would pay, and the 30% or higher tax bracket is a great spread to take, and a dollar saved today is better than a dollar saved in the future. So that is why I think, I stress to all active and passive investors to make sure that they're in a project, or if they have the opportunity to do cost segregation, it's pretty much a no-brainer in my mind. Okay, great.
So now you're going to get, instead of the $33,000 of deductions every year, so now in the first year, let's look at this chart over here. So what are we looking?
August, so it's prorated. Yeah, so exactly. This is basically, these are all of your estimates that you gave us, right? So in 2018, this is we bought the property in August, which is why you're seeing this $23,000 number. But probably the $83,000 number is more of it's a full year of depreciation. So you can see from Yona's estimates, instead of taking 33,000, it's closer to 83,000 in year two. So kind of explaining this chart to everybody. I know it's a lot of numbers, and I hate putting too many numbers up on the screen, but essentially, normally you would just get 39-year life divided by that 1.288 number that we talked about. But with cost segregation, it allows us to do 15-year and 5-year. And these two columns, the 5-year and 15, those add up to the $215,000 that we had on the previous slide. So that's the acceleration that you're getting. Yona, do you want to add anything more to this slide?
Yeah, so this is without calculating the bonus depreciation, obviously. Right. This would just be the spread of regular cost segregation over the 5 and 15 years, which is, like you said, prorated in the first year of ownership. If bonus depreciation, however, is not prorated, you get those 5 and 15-year assets, all of it in the first year, or 50% of it in the first year.
Absolutely. So great. So let's talk about this project. So this is Aspen Park Self-Storage. And in this case, investors had the opportunity to invest $50,000. That was a projected IRR of around 15.9% for the deal. And they got 2% of total ownership of the partnership. So they're going to earn taxable distributions via K1 every year. And the gains are offset by depreciation, or some of the gains. And the cost segregation accelerates those losses. So the way that the deal works is the investor gets an 8% preferred rate of return from operational distributions through the course of the project. And then in year 5, this kind of deviates from our cost segregation and depreciation discussion, but the project will be refinanced in year 5, or we're anticipating that, or we have a plan to do that. And the investor capital gets 100% return plus proceeds from a refi. I believe they're right around $13,000. That will be per 50, and that will be actually not taxed because it's just part of a refinance. So most gains from the investments are shielded from taxes during the course of the investment, which is great. So this is kind of the overall partnership benefits from that deal. So the way our partnership has elected to sort of take the depreciation expenses is we're using bonus depreciation, and we're only taking the 5 and 7 year life because we're being ultra conservative. So $77,000 will be used in depreciation, tax shield in year 1. And we project, just because we bought it in August, that the projected earnings $24,000. So the partnership will actually earn money on paper, $25,000, but will actually receive a tax loss of $38,681 in the first year, which is great. And we're only using 50% bonus depreciation in year 1, which allows us to spread more of this cost segregation over the subsequent years. In year 2, we actually plan to expand the facility by putting in roughly $600,000 of estimated construction costs, and those expenses will be applied to the depreciation of the asset. And so in year 2, we'll have $109,000 of depreciable expense. The projected earnings of the facility, since it'll have a full year of operations and distributions, and it'll be a larger facility leasing up, will have $72,000 of earnings. But of that $72,000, only $7,265 will be taxable. So what a great tax shield that cost segregation and bonus depreciation provides. Year 3, you can kind of see the numbers. Year 3, we have a little less depreciation. Kind of goes back to that $77,000 number. And our projected earnings are a lot higher because the facility is much larger. We're actually going to double the size of it. But still only $112,000 is actually taxable of that earning. So quite a significant tax shield. Year 4 is pretty similar. And then in year 5, it really gets turbocharged because we have the depreciation expense still. And I'm only demonstrating 5 years because the asset plan is about 5 years long, but we can extrapolate this out. But we plan to sort of refi the asset in year 5, and so we just wanted to show you kind of what those first 5 years look like. And in that year, with the proceeds from the refinance event, $851,000 will be awarded to the partnership from investment proceeds and from operational distributions, but only $69,000 of it will be taxable. So it's a really great way to have that, like I said earlier, that cash in pocket and the lower amount of taxable income on paper. So this kind of breaks down what it looks like. So you say, okay, that's great. The partnership is going to save about 43% of the taxable income as a whole. But the way that the deal is structured is the investor gets what's called the preferred rate of return, and we could go deeper into that. But essentially, the investors are getting most of the cash flow from the deal. So they're actually going to get, they're getting pretty much all of the operational distributions from the asset as the cash investor. But they're not going to have, they're going to have more taxable income from the deal. So this kind of breaks it down and says, okay, in year 1, because if you invested $50,000, you get a 2% ownership. Your cut of the depreciation tax shield is $1,551. You're projected to earn the $1,000 because it's prorated for the year. You'll actually have $1,000 cash in pocket, $1,023, and you'll actually have a passive loss in that first year of $242. And I wanted to kind of focus on this because, if you think about investing in another deal or another asset class or a stock or some kind of short-term investment, that goes into that hits your taxable income, earned income. So, for an investment that, puts $1,000 in your pocket, for those few months of months of ownership, you'll have a $242 loss where a comparable investment may earn you $1,000, but you may be subject to as much as 35% of taxes. So you may actually only put $650 in your pocket versus the $1,023. So you might actually, when you compare an asset, when you compare an investment side by side, and you say, well, this one pays 8% and this one pays 8%. Consider what the tax advantages are, because really in this case, you would have to earn over $1,500 cash in hand to net the same benefit that a $1,000 payout would make in year 1. So, it's really important to kind of see that. Yeah, that sort of benefit. So, yeah, we kind of ran the numbers on that, and you just basically apply, a 65% multiple for that if you're earning in the 35% tax bracket, or you could do it if you're in the 30 or the 25. So in year 2, obviously there's a much larger gain in year 2 from operational distributions. So the projected taxable for that, with your tax shield of $2,184, about 20%, gives you a $1,700 taxable when you actually earn $3,000. So again, good benefit. You can see in year 3 and 4, and then in year 5, this is my favorite year, where you get the benefits you get the refi benefits. Where we actually return your $50,000 plus you get $13,000 of proceeds from the refinance from a projected standpoint, but only $3,400 of that is taxable. So you're earning $19,000, but you're actually being taxed on only $3,400 of it. So this kind of gives you a little bit of a annual return perspective. So it kind of shows you your projected earnings and then against your tax payment that you'd actually have to make on that, assuming that you're in the 35% tax bracket. So this one really gets me excited. I'm really happy to kind of see investors, get cash in pocket and then a loss or a reduced amount of taxable income, on paper. So So with that, we're getting pretty close to about 45 minutes into the presentation. Yona, why don't you take us home, and then we'll open it up for a Q&A.
Unbelievable. Ryan, first of all, thank you for putting this together and the presentation, especially the breakdown of your specific investment and the breakdown of the earnings was just incredible. Very well and thoroughly explained, and I think everyone benefited here a lot. If you feel the same, please shout out in the chat box. And of course, if you have any questions at this point, now's the time to ask them in the chat box. I just want to wrap this up by saying, obviously thank you to Ryan and Mark for joining us, and everyone, whoever you are out there, for joining us tonight. And cost segregation, just to finalize, is an amazing tax strategy for real estate investors to increase their cash flow, to shelter their income from being taxed, and to take that money and use it to reinvest and make more money with your money. And like Mark said before, the time value of money is played out here. A dollar today is worth more than a dollar tomorrow. So, take the interest-free loan from Uncle Sam and use it to make more money that's not taxed. And that's really the wrap of what cost segregation is. Our contact information is at the end, so obviously feel free to reach out to all of us. And questions?
So somebody asked if the webinar was available via recording, and absolutely, we will send this out via recording. And also, there is there are slides in the handouts for the webinar in the GoToWebinar kind of area. So if you want the PDF slides, we've posted them in there as well. So the next question we have, and I'll throw up the contact information on the screen here. Are there any restrictions to what you can cost segregate? Can you do it on a single family home, or is it better for multi-units?
That's a great question. So there is really no tax limitation to what you can cost segregate, meaning any property that's an investment property theoretically can benefit because the assets that are in any building are laid out in the tax code and what the asset lives of all those things are. However, and I make this, and I should have probably said it before, so that's why it's such a good question, is that generally speaking, it's really a percentage. It's really of the basis of the property. So generally speaking, our firm particularly, I know there are other firms that will do this on single family homes and with any basis whatsoever. Particularly speaking, we generally don't push it if the asset's not purchased for more than $1 million and at least $500,000, because at that point you're going to see significant benefits. And as we pointed out here, this asset was purchased for $1.5 million, this self-storage asset by Spartan, and there's significant benefits here. Everyone can see. However, the lower you get on the basis, the actual purchase price, the less value there is there, and there may be reason to do it, to get whatever tax benefit you are. However, our firm particularly, doesn't push it. So just to clarify that again, there are others out there that will do it for any. Not that the cost necessarily, and this is just another point I want to say, not that the cost necessarily won't, be worthwhile. In fact, our firm generally charges between $4,000 and $6,000 for a cost segregation study, unless it, is based on its scope of work. So most properties will fit under that category unless they're massive, huge retail or, large facilities bigger than that. So the cost definitely is worth the tax benefits involved. However, when you're getting under $500,000, it's not as substantial.
Yeah, I think that the other consideration also is to bear in mind how long you plan on holding the property for. If you plan on selling it next year, this is something that tends to pay off over a longer time horizon. So it's a good exercise to sit down and see how it pencils out. Although clearly you have some arbitrage between depreciation recapture and your marginal tax break, it is still more worthwhile if you plan on holding onto the property for at least a little while longer. And I also know, I'm sure that Yona would be very happy to see how the benefit might pencil out for anybody who's curious about it for the project.
Sure. And like I said, that's, our firm and many firms provide an upfront, totally complimentary, analysis of your property to kind of show you the benefits upfront of what our projections would be. So, you can see what kind of the spreadsheet that Ryan showed before on the slide earlier, that you can kind of see what the breakdown is going to be, what your tax benefits will be over the next 5-15 years, and then make an educated decision if that makes sense for your specific situation.
That's great. And yeah, and I would say that, Spartan Investment Group, for all of our storage and RV park and assets that we acquire that, kind of hit those marks, and we have a plan to hold and operate for more than a year, like to Mark's point, we do some type of cost segregation study on the property so that, we take advantage of these tax shields for the passive investor and the partnership in a whole. I think you answered, the one of the other questions, what the average cost of the study would be, and I think you said between $4,000 to $6,000. Is that right? Did we lose you? I think that's
mute. Yeah. So on some smaller properties, it may even go a bit lower, and on larger properties, it may go a bit higher. When I say large, I'm talking like large shopping malls and things that in the hundreds of thousands of square feet, or millions of square feet. And we've done plenty of those projects. So yeah, but generally speaking, that's why I gave generally most properties, especially multifamily self-storage, a lot of them are able to take findings from one unit, and actually the IRS allows you to apply those findings to the other units. So for example, in a multifamily unit, you may have 6 or 7 different layouts of unit types in a 200 unit building. So the engineer will actually only need to go into each unit type and use those findings to apply to the rest. So the actual scope of work between a 20 or 30 unit multifamily building and a 200 unit multifamily is not much different. So the cost is not going to be much different.
Yeah, and I think that's a good point, because the engineer tonight at our storage facility is only going to be looking at a handful of units, because the building construction is very similar, and there's about 128 or so units on the property. So that's a good point.
Right.
Well, with that, I don't see any other questions in the queue. We'll do a final call for questions, and we'll wrap up.
Ryan, you might want to scroll to the contact slide at the end there, just so people can see where to reach us if any questions come up after we hang up today.
There it is. It's up. It's also in the webinar slide handout. If anybody wanted to reach out, that's my personal number and my email, and then the same goes for Yona and Mark.
Yeah,
Thanks for joining us. Yeah.
I would recommend if you haven't already, connect with me on LinkedIn, a platform I'm pretty active on daily and putting out content, and there to kind of spread the word about cost segregation and many other real estate related topics. And thank you again, Ryan and Mark.
Yeah, thanks, Yona, and thanks, Mark, and thanks for everybody that joined tonight. Have a great evening, and we'll be sure to send out the recording when we're done, and we'll stay in touch. Thanks, everybody. Have a great night.
Until next time.
Thank you.
Bye.